Good evening, everyone. Let's look at the concluding part of IAS12 income tax. I want to look at further questions on income tax so that we understand this standard derivative because it's an important standard as long as you are writing FR. So you should understand this standard very, very well. Please let's do ourselves good and review questions on this standard. Look at those questions. Try to attempt questions on your own and always ask questions. Oh, this standard though. I tell the question on it too. This place, so how would they get this one? So let's rub mind together so we achieve the same goals. Now this question is adapted from ICANN past question, which is November 2018. Because of our time, um, I will employ us to read the question on our own and let me explain this question, the question and the solution. Now, you are told to calculate the current tax expense for the period. When we are asked to calculate the current tax expense for the period, we are asked to compute the tax computation, in which that is the chargeable profit or the taxable profit, in which you will multiply your 30% interest tax rate on to arrive at the tax expense or the tax provision, the current year provision for the year. And this is using the tax laws or rules, which is you have to add back disallowable expenses and deduct allowable expenses, or add back allowable income and deduct deduct disallowable income and add allowable income. Now this question we are told that the tax, that the accounting profit for the year is 225 million, 225 million, 225 million, which is this. And again, we also told that there is the company has assets, which is building, plant and machinery, and assets held under finance lease. Assets held under finance. These are the three non-current assets for the year, as at the year end, which is the carry amount. Now, this asset we look at the depreciation. So I told you the depreciation for this for building is 10%. Is 10%, and you're told the capital allowance is 105 million. For plant and machinery, you are told that the depreciation is 30 million. Why for asset under finance lease, you are told that the depreciation is 20% annual. So the three depreciation, they are disallowable expenses, so we had them back. So that is where I came here. We look at it. 10% of 175 million is 17,500,000. Why this? We are told is 30 million. So we are giving. Why this is 20%, and 20% of the carry amount, which is 200 million, which is 40 million naira. We also we are also giving 17,500,000 as a allowable provision for depreciation. They provide for depreciation. Remember, in tax, it's a disallowable expenses, so we will add it back. So any provision for depreciation, which is any provision or allowance for doubtful debt. If it's specific, is allowable, but if it's provision, is not allowed. So mostly, provision is not allowed for receivables. So we add it back. We are also told that we have interest payable, which is deducted. We are told that the interest income is taxed and the interest expense is allowable, but on cash basis. Remember that the interest on finance lease under amortization, the interest calculated is a provision, but the actual interest that you are paid that you will pay to the lessee is the renter. But in accounting, the actual interest paid is not recognized as expenses, so it must pass through um cash and liability the lease liability. So but in tax, this are the cash paid for lease rental is the actual interest, but in accounting is not. So that is the difference between the accounting aspects of lease and the tax aspect of lease. So we add back the 17,500,000, which is why the which is 8,250,000, which is given here. So for the lease, okay, for the lease for the lease for the lease now, so the 8,250,000 is given as our interest payable, which is under amortization. So we add that back because it's a provision. Why the fines? Remember, fines is not allowable expenses for tax purposes. So if you are if FRS fine a company, that fine is not allowable for tax purpose. So we add it back, which is 25 million naira. So we are giving the fines here 25 million is added back. These are expenses. And why the annual finance charge the annual finance charge, which is we are giving on a straight line basis. The annual finance charge is 36,667,000. So is also what added back. So this interest payable, because it's on accrual basis, it's not a cash item, so we add it back. But the annual finance charge is the interest on amortization. So we add it back. The total is 174,917,000. So we add it back. Why allowable deduction will be one, the interest income. So we list the interest income. Interest income is a interest income is the income. Remember that in the accounting, income is added, that is, income increase our profits, and this income is a disallowable income. It's a disallowable income. So disallowable income will be deducted because it's not cash item. Look at it. We are told here that the income, tax, and interest, that they are not what they are on, both on cash basis. So for tax basis they are on cash basis, but here we are giving that the interest income, it is the interest receivable. Interest receivable. When you say is receivable means is not cash, is accrual. So the interest receivable is also disallowable income. So So because it must have increased our profit, we will have to deduct it. So we deduct it, and the allowable deduction, which is capital allowance for building, we are giving capital allowance for plant and machinery, we are also giving. Why the lease rent, as I've said before, lease rents are the amount paid, the actual amount paid for lease is the allowable deduction or allowable expenses instead of the annual interest charge. So we will now deduct that. Then our chargeable profit. Our chargeable profit is 195 million 195,417,000. So when you multiply it with the 30%, we have 58,625,000. So this is your income tax provision. So income tax provision. Why B, we are told to calculate our deferred tax provision and the one that will be charged to profit or loss. Deferred tax is charged to profit or loss. Now, this is very simple. As of using our previous knowledge in our last class, we should bring out a format which is the carrying value, the tax base, and the temporary difference. Now, when the temporary difference is a liability, which is if we warrant a deferred tax liability, we call it temporary taxable difference. But why is an asset, we call it a deductible difference. So I will bracket it, deductible difference. Now for the building, let's look at building. Now building, the carrying amount, we are giving the carrying amount for the building is 157,500,000. Now why the tax base, which is the cost minus the capital allowance, which is tax base, is a 70 million naira. So you can look at our workings here, which is when we are giving the 175 million naira for the building, when we less the capital allowance given is a 105 million, so we have 70 million. So the kind of amount is higher than tax base, so we have we have a temporary difference which we warrant a deferred tax liability. So deferred tax liability, which is 87,500, sorry, 87,500,000. So that you put 30 up. Now for the plant and machinery, we also give me the kind of amount which is there in our question. This kind of amount 250. Why the tax base, we have to minus our capital allowance from the cost. Here we are giving the cost here. For our workings, the cost here is 280. How do we get 280? When you add back your depreciation to your current amount, you will get the cost, which is 250 plus 30,000. We have 280. Then you now list our capital allowance, which is 25,000. We now have 255,000 naira. So the difference is 5 million naira, which is the tax base is higher than kind of carry amount, which is it will warrant a deductible temporary difference, which is the same thing as your deferred tax asset. Now for the asset head on that finance lease, so we have the kind of amount of 200 million, which is a deferred tax liability, while the current asset or the income, they follow the same principle with asset. If the kind of amount is higher than the tax base, it will warrant a deferred tax liability for assets and income. Now let's look at trade receivable. Trade receivables, we are told that the carrying amount of trade receivable is 182,500,000. thousand. So which is given here. Now, each trade receivables, we are told that there is an allowance for receivables, which is 17,500,000. Now, this allowance for receivable will be add back. We will add it back to our current amount of trade receivable to know the tax base of trade receivable. So when you add back um 182,500,000 with 17,500,000, we have 200 million naira. 200 million. So the tax base is 200 million, while the carry amount is 182,500,000. So the difference is 17,500,000. 17,500,000. 17,500,000. 17,500,000. So this difference also lead to a deferred tax asset, which is a deferred tax temporary deductible. So we have income. Our income, we are told that income is taxed on cash basis, but for in accounting is accrual basis. So that's why there will be a temporary difference, because the day that the tax authority recognizes it will differ from the day the accountant recognizes it. So we have a temporary difference of what? 2,500,000. So it will warrant a deferred tax liability. So a fine is not allowable. It will not allowable as an expenses, never. So in any day, so there is no temporary difference for fine. So that is why we had the 25 million back in our tax base, so that there won't be any temporary difference. Why the interest payable will also be recognized when there is actual cash payment. So the interest payable, we have the 8,250,000 as our deferred tax asset, or you want a deferred tax asset in future. Now, the finance this obligation is a liability. And liability and expenses are the same. Now, it will warrant a temporary difference of same amount, which is 216 million naira. Now, is the carry amount is higher than the tax base. So, and when carry amount is higher than tax base for liability, it will lead to a deferred tax asset. So by the time we add all the liability together and all the assets together, we have, for the liabilities, we have 290 million naira, while the assets we have 246,750,000 naira. So by the time you multiply it with your tax rate, we have 8,700,000, and we have I'm very sorry. When you multiply with 30% is 87 million, not 8,700,000. Is what? 87 million. It's a mistake from my part. Is what? Is typical error. 87 million. 87 million. 87 million. So the difference will now give us 12,975,000. So this is our deferred tax liability. So the deferred tax component for the C above will be our income tax provision plus our deferred tax liability. So our deferred tax liability. So our deferred tax liability is 12,975,000, while our income tax expense is 58,625,000. So our total income tax, or total tax expense, is 71,600,000. So with this, We should understand this illustration, and let's look at another illustration where there is a changes in tax rate. When there is a changes in tax rate, it means that when we are carrying forward our deferred tax, we must use the tax rate of that year. Use the tax rate of that year. So let's look at this illustration just to understand that when we are given a different tax rate for different years, our income, our deferred tax, because deferred tax is a non-current asset or liability. We must use the balance, the deferred tax that will be carried forward. We will multiply it with the tax rate of that year. The increase or decrease will take it to our profit or loss. The increase or decrease will be taken to the profit or loss for increase or decrease in a deferred taxation. So you are giving the current asset, the current amount, and the tax base. And we are giving the tax loss. Remember that we are told that tax loss is a we warrant a deferred tax liability, which is a credit tax, a credit note. So it will carry forward. Now we are told that the tax rate for different years for 2012, 2013, 2014, and 2015, and we are told that the loss above is a tax loss incurred in 2012. So 2012 that they incurred the tax loss. The company is confident about the trading prospect in 2013. So that will be a trading prospect. So the company will not liquidate in 2013. So it will continue for a foreseeable future. And the temporary difference the temporary difference in respect of non-current assets is expected to grow each year until beyond 2015. Losses may be carried forward for offsets in what 1/3 into each of the next year. So it will be 1/3, not everything. It's 1/3. So it's 1/3. So this the non-current assets will warrant a deferred tax liability, a taxable difference. While the tax loss is 70,000, 90,000, which will lead to a deferred tax asset. So the deferred tax liability that we have is, which is for that 2012, is the 31%, which is so when there is a deferred tax for the foreseeable future, that year, that the tax rate, the tax rate for that future will be the one that will be used to calculate our deferred tax presently. Now our deferred tax, the rate that is envisaged is 2015 rate. So 2015, the rate will be used now. Will be used. So we have so we have 31 for 2015. So multiply it with 31, we have 43,400 naira. Why the deferred tax asset that we carried forward for the next 3 years? Remember that for the next 3 years will be 2013, 14, and 15, because we are in 2016. So it's 13, 14, and 15. So that is 3 years. Now, and the tax rate will be 34%, 32%, and what 31%. So in 2015, there is a mistake in the tax rate. Is what 31%, not 34%. Please, it's not 34%, it's 31%. So when we search for our balance for the tax liability is now 14,300 naira. So this illustration is very, very simple. So we can apply our knowledge in our previous class to solve this question. It's an assignment. Why this is not for our level, business combination is not in our syllabus, though it's for our advanced level. Though you can read them up, but we should be able to talk about the disclosure. These are what we should be disclosed in regard to IAS12. So if that is understood, please read the disclosure up. very well and solve the assignment. Let's try and solve assignment. Let's know if we actually on following the lecturer or not. By solving assignment, we encourage lecturers. If that is noted, um, we've come to end of tonight's class. Good night.